If you would like to receive a stream of income from a charity for the rest of your life while donating to the charity at the same time, you should consider using a charitable remainder annuity trust, charitable remainder UniTrust, or a charitable gift annuity. The income that you receive from these annuities might be lower than what you would receive from a non-charitable annuity because the main purpose of a charitable annuity is to support a charity. These type of charitable annuities are often used in estate planning as a federal tax strategy. These annuities can be used if you're trying to keep a level income, especially if you just received a financial windfall or you had an unexpected high income year. The goal here would be to offset your increase in income and receive level payments each year instead. As of 2023, you can now use a qualified charitable distribution from an IRA to fund up to $50,000 to one of these charitable annuities. If you want to know more about charitable distributions, please watch the video above. Once you put your assets into any of these charitable annuities, you won't be able to get your assets back, and you no longer have control over the assets. Depending on the charity, you might be able to donate cash, real estate, publicly traded stock, private business interest, or private company stock. You cannot donate S corporation stock to a charitable remainder trust. Unfortunately, some charities can accept appreciated investments, but if you are able to donate appreciated investments directly to the charity, you could lower or eliminate your capital gains tax on these investments. If you were to sell the investments instead and then donate to charity, you would pay a capital gains tax on the appreciated investments. So donating appreciated assets to charity will provide a greater federal tax break than donating cash. A federal estate tax is based on everything you own at the date of your death and only applies to large estates. If you have a large estate, you can establish a charitable trust or contract, and any asset that you donate will be removed from your estate. Since your estate will be reduced, estate taxes should also be lower. If you can't itemize your deductions on your federal tax return, then you won't be able to take a charitable deduction for your charitable annuity. On the other hand, if you cannot use the entire deduction in the year that you establish the annuity, you may carry forward your unused deduction for up to 5 additional years. If you use a standard deduction in any year, your carryover amount will be reduced for the amount that would have been allowed if you had itemized that year. For example, let's say that your adjusted gross income for last year was $6,000 and you use the standard deduction on your federal tax return. Let's also say that you set up a charitable annuity and contributed $3,600. We will assume that if you had itemized, you would have been allowed to take an itemized deduction of $3,000 for your contribution that year. Even though you use the standard deduction, you would carry forward only $600 to the next year to use as a charitable deduction. So, at the end of the day, it is best to set up a charitable annuity with an amount that will allow you to take an itemized deduction. With the charitable gift annuity, you can only donate to one charity for each annuity. If you wanted to donate to more than one charity, you would have to set up multiple annuities. With a charitable remainder trust, the trustee might be able to change the charitable beneficiary, but it depends on how the trust is established, and it might cost you legal fees to make changes. A workaround to be able to donate to multiple charities without setting up separate annuities or paying additional legal fees is to name a donor-advised fund as a beneficiary. For instance, if you were to use a donor-advised fund, you could have the fund send over your regular monthly or weekly contributions to your church and other charities without having to set up separate annuities. By using a donor-advised fund, you can recommend grants to virtually any IRS qualified public charity. You can change the charities receiving the donations, you can control the amount and timing of the distributions to charity, and you can advise on how the charitable dollars are invested. Also, a donor-advised fund can usually accept appreciated investments that other charities may not be able to accept. With a charitable gift annuity, you will establish a contract between you and a charity where you will make a donation in exchange for a fixed income. You can even establish a gift annuity for someone else so that they will receive the income. Since the income is fixed, it will not be adjusted for inflation. If you itemize your deductions on your federal return, you will be able to take a partial tax deduction for the donation. You will only receive a partial tax deduction because a charitable gift annuity is considered to be part gift that can be used immediately and part investment. With a charitable gift annuity, You will donate to a charity, and the charity will put the gift in a reserve account and invest it. You will receive fixed monthly or quarterly payments based on your age at the time of the gift. Typically, the older you are, the higher your payments. You can take an itemized charitable donation deduction on your federal tax return based on your life expectancy. On average, the charitable deduction will be 25% to 55% of the amount that was transferred to the charity. After your death, the charity will receive the leftover amount of the gift. Every year, the charity will send you a 1099-R indicating how the payments should be reported for income tax purposes. If you make a cash gift, part of the payments will initially be taxed as ordinary income, and part will initially be tax-free as a return of principal. If you donate appreciated investments owned for more than 1 year, part of the payments will be taxed as ordinary income, part as capital gain, and part may be tax-free. With the charitable gift annuity, most of the capital gains on appreciated assets will be avoided, and the portion that is taxed will be spread out over your lifetime payments. In any case, part of the income will be subject to federal income taxes and possibly state income taxes. If you are considering a charitable gift annuity, you should check with the nonprofit organization first to see if they offer charitable gift annuities. I know that a lot of universities do offer them. Now let's look at a charitable remainder trust, which is also called a CRT. Normally, a CRT requires a larger contribution than a contribution made to a charitable gift annuity. For a CRT, you will make a donation of at least $250,000 to an irrevocable charitable trust. The trust can be established while you are alive or upon your death. You should consider establishing a charitable remainder trust upon your death if you want to provide for someone after your death, with the remainder going to the charity that you choose. When you set the payout rate for non-charitable beneficiaries, you must make sure that the remainder left in the trust is at least 10% of the initial net fair market value of all assets placed in the trust. You will decide if the trust will end at 20 years or earlier than 20 years, or if it will end after the death of the last person named in the trust. After the trust ends, whatever is left in the trust will go to one or more public charities or private foundations that you choose. The trust will file Information Return Form 5227 each year. The trust will give a Schedule K-1 to you and/or any other people named in the trust. With a charitable remainder trust, the non-charitable beneficiaries will pay tax on the income stream, which is categorized into 4 tiers. Tier 1 is ordinary income and qualified dividends. Tier 2 is capital gains. Tier 3 is tax-exempt income, and Tier 4 is return of principal. Taxes start at Tier 1, and only when a tier of income is exhausted does the next tier apply. Your partial income tax deduction will be based on the type of trust, the term of the trust, the projected income payments, and IRS interest rates that assume a certain rate of growth of trust assets. There are 2 basic types of charitable remainder trust. There is a charitable remainder annuity trust and a charitable remainder UniTrust. If you want to receive a set dollar amount each year, you would choose a charitable remainder annuity trust. The amount that you receive has to be at least 5% and no more than 50% of the value of the assets placed in the trust when it was established. You will receive the same payment amount each year based on the starting value of the assets. You won't be able to make additional contributions to the trust. Instead of receiving a fixed dollar amount, you can establish a charitable remainder UniTrust to pay you a fixed percentage of the value of the trust each year. The payments that you receive must be at least 5% and no more than 50% of the fair market value of assets in the trust. Every year, the assets will be revalued and the payment will be based on that value. So you will receive a different payment amount each year based on the new value. You can make additional contributions to a charitable remainder UniTrust. Before we wrap up, in the event that your trust is ever audited, I would like to share some things that an IRS agent will review on the return. The agent will check to make sure that donated assets are recorded on the books of the trust at the same cost as the donor, that all asset sales were recorded on the books for the trust, that non-charitable beneficiaries are not receiving extra distributions from the trust, that the charity is not receiving a cash payment up front instead of receiving a remainder interest, and that donors are not taking loans from the trust or paying personal expenses with trust funds. So when it comes to your charitable trust, please be mindful of these things. I do appreciate you spending time with me and subscribing, but this was not official tax advice or legal advice. Please consult with your tax advisor for personalized planning. Although I may not be able to give you official advice, feel free to ask me a question in the comments section. All the best to you.